Schedule 1A, no tax on tips. This is an area that's gotten a lot of attention, part of the One Big Beautiful Bill Act. This is something that's new for 2025 on Schedule 1A. There's four different deductions there. The first section is the no tax on tips, which we're covering here. Everything starts on the Schedule 1A with modified AGI, which calculated at the very top of that form in Part 1, and it's used through all sections of that schedule. So what is the definition of modified AGI? For most people, it's going to be the adjusted gross income. There are some add backs in if someone had some foreign earned income exclusion under Code Section 911, or perhaps they're a resident of American Samoa, they have an add back there under Code Section 931, or a bona fide resident of Puerto Rico, there is also an exclusion there that's an add back to get to modified AGI. So most taxpayers don't have income from these areas. For most, it will be their adjusted gross income. Again, it's calculated at the top of the schedule, and you work your way down to line 3. If there are no adjustments, line 1 and 3 will be the same, and line 3 is used throughout this entire schedule. So here in the tips section, which is part 2 of the form, that basically translates or transfers to line 8 of the schedule, and that will determine whether they're eligible or not. The part 2, no tax on tips, has to be qualified tips. Now, by definition, this is a cash tip. If someone were to leave a waiter, perhaps a non-cash tips for maybe tickets to a basketball game, even though if it might be declared as income on the tax return, it's not a cash tip, so it doesn't meet that definition. There would be no deduction for that. This is temporary, as most provisions in the One Big Beautiful Bill that are permanent relate to business. This is a personal deduction, and it sunsets in 2028. So it's good for 2025 through 28. At that point, it sunsets. Whether it goes beyond that depends on whether they come out with an extender bill between now and then. This is a basically limited to lower income individuals. So there is a phase out, and if your income is too high, you don't get this deduction at all. We're talking about a deduction of $25,000 regardless of your filing status. That would be the deduction that comes off taxable income, not adjusted gross income. We'll show you, again, this is a deduction that comes in after AGI is calculated. So non-qualifying tips, any amount received for the performance of service that's related to a felony or misdemeanor. So if someone's involved in any illegal activity and they receive a tip, chances are they wouldn't declare that as income, but they certainly would not get any type of deduction if they did. The deduction itself, when we're talking about self-employed individuals, this is limited to the profit from the activity. So what does that mean? Unless the business shows a profit, they're not going to get a deduction even if they received a tip. Here's an example of what we're trying to illustrate there. Let's say that we have a taxpayer who owns a small catering business. She did a great job throughout the year. She received $6,000 in tips over and above what the contract specified for her catering activities. So she includes that in income. However, when she adds up her expenses, let's say she has $82,000 of income, $6,000 of the tips are included there. She has expenses of $83,000 during the year. So if the business necessarily had a loss, so she gets no tip deduction, even though in fact she did receive some tips during the year. So you have to show a profit as a sole proprietor. The other thing that we keep in mind for those people that are business owners, if they do take a deduction for tips, they're not allowed to include that as a deduction for QBI. This prevents business owners from double dipping. So there are situations, let's say that our last example, that catering business, she actually had a $25,000 profit. She is entitled to, under Code Section 199A, qualified business income deduction. Well, she can't take that $6,000 as part of that deduction in that calculation. So compliance, this is where it becomes a little bit tough. They passed this bill on July 4th, 2025, but it made it retroactive for the entire year. There were a lot of people not tracking qualified tips for the first 6 months of 2025. So the 2025 year is going to be pretty difficult to trace. Some additional requirements. You have to have a valid Social Security number to basically take this deduction. If it's not matching on the tax return, it's treated as a mathematical or clerical error. So what does that mean? The IRS can change that tax return without an audit, and it's up to the taxpayer to make sure that they correct it if they perhaps transposed a number and it didn't match the name on the tax return. Now, the IRS basically came out and said they're not going to make any changes for withholding tables for 2025 related to the new law. So if someone has income that's reported and their taxes that are withheld accordingly based on that higher income, they get the deduction. That could translate then into a bigger refund or a lower liability on the tax return for 2025. Reporting, basically they're asking employers to use a reasonable method to come up with what happened in the first 6 months. When we're talking about the approximation, it's going to be pretty ugly for 2025 because some of it could be guesswork, and we'll get into the details a little bit later as to why. So for distinction, you have to basically determine what's a deductible tip and a non-qualified service charge. What does that mean? As far as tips go, they have to be, for this deduction, voluntary. So if a restaurant has a standing policy that all service basically is going to be charged a 20% service fee, then and that's left or added on to the bill, then that does not qualify for the deduction. Now, if I left a 25% tip, so 5% over what the restaurant had added on, 5% would qualify, that additional amount, but it has to be a voluntary tip, not a service charge. How do you track that? Well, that's the problem in 2025. So a lot of people are going to have to try to come up with the records as best they can to file for the 2025 tax return. For 26, we do have a bit of guidance here. They are going to have some changes made on the W-2. In box 12 on the 2026 now, W-2 will have 3 new codes, and box 14 will basically be split into 2 parts. That's where they have additional information on the tax return itself. So box 12, we're talking about code TP for total amount of qualified tips. That's for 2026. That's one of 3 different new codes that we'll have for 2026 W-2s. Box 14 in 2026 will be split. They report the occupation of that employee that's receiving that tip to make sure that they are in a industry that customarily receives tips. And we'll go through what we're talking about there in just a minute. So here's what the draft form for 2026 is going to look like. That code that I talked about, TP, will show up in box 12. And then box 14B is Treasury tipped occupation. So could be a bartender, could be a waiter or waitress. It might be someone that works as a dealer in a casino. Could be someone that works perhaps as Uber or Lyft, and they receive tips as part of their ongoing business. So occupations that customarily and regularly receive tips basically came out in proposed regs, an entire list. They basically have several categories here: food and beverage, hospitality, home services, personal service, appearance and wellness, so your beautician, your barber, recreation industry, transportation delivery. That could be your Grubhub driver, perhaps someone that drives for Uber as well. So these are the ones that they came out with, the different codes that will show in box 14. Here's an example of how the math works. So let's say we have a married couple. Modified AGI is $350,000. The total qualified tips is $15,000. The annual deduction is limited to 25. So remember, in this situation, they're under that threshold. So 15 is still good, but we have to give a haircut as well. The modified AGI phase-out threshold for a married couple is at $300,000. So we take that reduction. That leaves us basically in excess of $50,000. That translates into a reduction of this deduction on the tax return on Schedule 1A of $5,000. So from the 15 that qualified tips, they subtract the 5, the deduction is limited to $10,000. This is what it looks like on the Schedule 1A. The no tax on tips starts with the qualified tax tips that have been received, and that's in this case $15,000. Down on line 7, this is where the limitation comes in. You enter the smaller of line 6, which is the total of what you had for qualified tips, or 25,000. That's where the limitation is going to come in. The modified AGI limitation for $300,000 here in line 9. We had total modified AGI of $350,000. That's in excess of $50,000. That translates into that deduction. So this is how it basically shakes out on the Schedule 1A for tax purposes. Now, for more information on other areas of tax law and to basically even sign up for our free monthly newsletter, go to our website at btb.tax. You can order textbooks if you missed one of our events, and check out what seminars and webinars we have upcoming for 2026 and beyond.